Ladies and gentlemen, we have an exciting panel today, which is the Contrarian Data Insights. When I was in charge of 3M Ventures and started the business in 2008, I was always asked, and I would have loved to have more data insight about corporate venturing and have some history of what happened, who invests in what, where, which areas, what is the trends. That was not the case in 2008. But we have two panelists today that give us much more insight and have done a great job on aggregating tons of data for many, many years. And I'm happy to introduce both of you to you. One is Doug Treffelett. He is the managing director of PitchBook Data, which is a company has more than 500 employees all over the world, headquartered in Seattle. You're in the UK, in India. You are gathering data from all kinds of venture capital, M&A transactions, venture capital, and maybe in venture capital you are number one, having the most and most relevant data collection. So we will hear a lot about your insights of your work for the last years. Toby Lewis, everyone knows Toby. Here on this panel, Toby is our strategic data analyst. Toby got very enthusiastic in the last 2 years in data collecting, although he's been doing that since the beginning of global corporate venturing. And 2 years ago, he started Global Venture Analytics. So we will hear a lot and see some slides, which can only be a glimpse of all of the information that we might have and that we might share. Furthermore, Toby is hosting and creating some exciting surveys every year, and you are part of that for sure. And we might hear about some outcome of these surveys as well during the presentation. So let's maybe start with Toby on the first slides, and let's move to slide 1. Toby, what size of groups are you seeing during doing corporate venturing in general, and do you think this universe is expanding?
Yeah, so it's fascinating. Stefan and I have been talking a lot over the years about the influx of groups into corporate venturing. So we've seen roughly half of the top 100 companies in the Fortune 100 are doing corporate venturing. So the largest companies, it's literally 1 in 2, and that begins to drop down to roughly 1/3 when you take out the whole Fortune 500. And Stefan has sort of come to us sort of saying, well, the penetration of corporate venturing we've been seeing clearly at the sort of big guys. We heard from the GEs of this world earlier this morning, the Microsofts, and it's not very surprising that those kind of companies, if they aren't doing corporate venturing, should be thinking, should we be doing corporate venturing? And then as a company gets smaller, it becomes a bit more of a resources discussion. And Stefan believes there's a sort of very large pool of sort of roughly sort of thousands of companies that possibly could be doing corporate. I don't know.
Yeah, I know I'm asked the last years by a lot of mid-sized companies to start venture activities, and you see that a lot in Germany right now, where smaller companies, the Deutsche Mittelstand, wants to start corporate venturing themselves, and some do that quite successfully, some don't, and but they're all asking about the same: what kind of data and what kind of proof for corporate venturing do you have? And this is some of the topics we want to talk about today.
And so next slide. So as you can see sort of here, you saw this slide this morning. Sort of our data indicates on some metrics there's sort of roughly 1,500 groups that we've tracked doing venturing. So we count the sort of the Googles of the world. There's a discrepancy in this data, and that sort of there's one slide on the left showing 1,070, which are the groups that we've tracked that do corporate VC, and that's pure corporations. And then we think there's roughly sort of 1,500 groups where there's sort of distinct entities within corporates that do corporate VC. So there's the Googles of this world have any number of organizations. They have sort of Google Capital, Google Ventures, Google Corporate, and sort of odd parts of the company doing venturing, which is the reason for why the number's a bit bigger on one side of this chart. And then, but when you drill down into it, at least in what is transparent, we're seeing that the numbers are sort of doubling of those groups that are active in any given year, but there's also a few of these corporate venturing groups don't seem to have any sort of transparent activity. But what we're seeing, and I think from the discussions you've been having today, you probably found that there's a lot of people around that are getting into venturing and looking into it, but not necessarily active.
What is driven market growth on the next slide, Toby?
So I think the major factor is corporates feel they need to be active in all the sort of areas of activity of venture capital, because it's having such a sort of strategic impact on their businesses. We think of the Ubers, the Airbnbs. These businesses have transformed things like the hotel sector or the taxi sector, and a corporation that isn't at least thinking about what these trends mean and perhaps investing to get an understanding of that is perhaps missing a trick. So the really interesting thing is the scale of transactions that corporates have been participating in have really sort of massively increased. This perhaps isn't that much of a surprise, given that sort of last year, where you see it really going up and to the right on the dollar side, a sort of 5 times increase. It's no surprise that those numbers have gone up, because we read about the sort of proliferation of the unicorns, with sort of 150 in the last year, and you're here when sort of Doug gives his view on the venture capital world, just how dramatic some of that stuff has been. So Doug,
maybe you can talk a little bit about deal flow, about capital invested, about valuations, and give us some insight.
Yeah, of course. Well, first and foremost, I just want to tell you a little bit about how we gather the data. Pitchbook's been around for 9+ years. We're headquartered in Seattle. We have 500+ employees, 2/3 of whom are involved in research, and it's a very nice combination of web crawling and scraping, where we're collecting and call it a big trawler net of information. We have 200 some in India who basically handpick this trawler net, and then we'll hand key it into a back-end publisher. We've got a QA team of about 50 that goes in and looks at that information to make sure that it's accurate and consistent, and that we're managing the disparate sources from where we get the information. And then we have a primary team, of course, that makes lots of phone calls, emails to all the different players in the space, whether it be the LPs providing capital, corporates, the sponsors, private equity, venture capital, as well as all the service providers, the law firms, the accounting firms, consultants, and so forth. One thing I'll say is that I see a lot of you guys taking pictures of the slides. I'm more than happy to provide those to you guys afterwards, so you guys aren't trying to spread out your little iPhones later on and figure out exactly what those numbers are. And we can provide some unaggregated data as well to you. So we've got a booth, and you can either walk up to me or one of the other guys in the back. What we're looking at here is all of venture capital deal activity, and this is over the last 10+ years. The line is the number of deals, and as you can see, that's a nice steady rise with a bit of a fall off last year, topping out at a little over 13,000 deals. The bar is capital invested, and in this case, we're looking at euros. A kind of a gradual rise until the last couple of years, where we had quite a spike, principally in later stage deals. The color coding is North America in light blue, Europe in green, and rest of world in dark blue at the bottom. And as you can see, all of those regions are growing evenly. The next slide we have here is corporate involvement in these deals. The green line at bottom is the percentage of deals where there's a corporate investor involved in the company at one stage or another. As you can see, we've got a kind of a nadir around 13% right around the time of the credit crunch, and moving up towards kind of 18-20% in recent years. What's interesting as well is if we look at the blue line, if you take all of those deals that corporates were involved in, they're actually accounting for a much more percentage of the capital. So these are bigger deals, they're later stage deals with close to 60% so far this year, and about 45% from last year.
On this slide, Doug, what is these tourist filing?
So I think it's the tourist expression came from our research team, and I think the tourists in many ways are here to stay. Obviously, we've got a full house here. The dark green line at the bottom is the capital committed by LPs into traditional venture capital funds, and in a one-to-one basis, you would expect that the light green line, which spikes up, which represents the capital invested into companies, would be parallel or effectively the same. But over the last couple of years, you've had a huge influx of capital from non-VC funds, and of course, that's being provided by all the corporates that are now investing more and more into this space, and we think more and more into later stage deals where there's a lot of capital required. I think we've got increased valuations as well with that. On the valuation side, we're seeing that when corporates are involved, the companies are deemed to be worth more. On the A round, which is the blue lines at the bottom, it's about 30%, consistently 30% more value or valuation of a company. And that's even more marked in the B rounds, which are the green lines. And the gap is, and the lighter green line is where there's no corporate involved, and that's a median pre-money valuation. And the dark green line is when corporates were involved. So it's corporate involvement is pretty significant in this space. I think that there's probably some pundits out there that are suggesting that maybe there's overvaluation with the increased capital that's being provided by the corporates. And the good news is that exits are actually quite healthy. This, similar to the first slide that I showed, are the number of exits per year. The line, of course, being the number, and the blue and green bars, the location. And so it's been pretty consistent, consistently going up. Obviously, last year was a bit of a fall off. As far as distribution or exits in Europe, it's about 30% UK. France and Germany are kind of plus 10%. And then you've got around 5% in Spain, Sweden, Ireland, Russia, and the Netherlands.
And it's interesting to see that Europe is playing a bigger role versus North America than it did in the last years, right?
Yeah, it's what's interesting is the share is fairly consistent across the years. But if you look at the deal count in Europe, it's basically doubled. From about 1,300 deals, and this is just Europe only, in 2010 to doubling that from last year. So the share is around 20% per Europe, but twice as many deals, twice as much capital as well. And that's both in investments and with exits also. And then finally, which is great news as well for the corporate involvement, this is median backed VC exit size, the blue line being without corporate involvement and the green line being with corporate involvement. So when corporates are involved, the exits are much bigger, and I think that's a healthy sign for the industry.
Okay. Next slide, Toby. The balance between strategic and financial goals, right? This is a topic that strikes everyone, always, right? So if I look at the 32% primary strategic, I always wonder, is there any opportunity to measure the strategic input of corporate venturing into corporates. This is what everyone questions himself if there's no financial gain. I don't know if there are data available right now already, but I know that you're working on that topic. So let's talk about this slide for a moment.
Yeah, no, so thanks, Stefan. In our sort of long discussions on this topic, and Stefan's been very sort of helpful advising us to how we should be thinking about strategic value so we can provide value to people in this room. And we've begun sort of talking with as many people as we can in the industry, doing surveys, interviews. My colleague Contrarian over here will probably be in touch with many of you to sort of get survey data that we're keen. We've been working. This is the initial sort of part of a survey that has sort of been supported by PwC, which we're due to publish in a report sometime over the summer towards the fall, suspecting in the sort of September-style timeframe. And what this slide shows is one of many different answers to these questions, and it's showing that more than 2/3 of groups have sort of financial return. There's some looking to purely strategic, and then we're looking to get some quantitative survey data on how people are tracking strategic return, and also doing interviews in an anonymous manner to make people comfortable at sharing their strategic insights in a way that we can try and at least distill some best practices relating to strategic value. So it's interesting, this slide, and this is one of just sort of many metrics that we were thinking of looking at in this strategic and sort of performance of financial sort of thing, is that sort of half of CVCs only are contributing 10 million to the parent corporation in terms of revenues annually. So there's an element to which clearly there's a lot of people who are at the same time in this survey saying they're very satisfied with their corporate venturing activities. So there are some outliers in this slide. So you see that there's sort of 3 on the slide that have contributed more than 500 million in revenues to their parent company on an annual basis. And you probably heard some of them talk this morning and over these sessions, and you can probably guess who some of those might be, although the data is clearly anonymous. But this kind of data we're hoping is going to give a bit more of an understanding to some of the questions that everyone in CVC is trying to answer. And until now, I don't think anyone's really been focused on trying to collect this data.
Great. So maybe you can sum up a little bit, Doug and Toby. What was your biggest learnings out of all of these data that you showed to us today, which is just, as we said, it's a small glimpse of huge works, and at the end of the day, it's some results that should be interesting for you, and you should send us the questions that you have or the insight that you are interested in to be able to do the right surveys, to do the right data research, to have some valuable insight, understand some trends of the future.
Yeah, I think that one comment, going back to the slide, the last slide, is that I think perhaps that some of the half of the corporates aren't seeing a ton of returns yet from their venture activities. I think it's early stages for some of these, as we saw the big spike from kind of 2010 forward. I mean, the turnaround, the exits of these companies isn't going to be immediate, and so it's not. It's off the books, at this point. I think that when these companies start to mature and we start to see exits and mergers, then I think that bar is going to grow as we go down the list there.
Yeah, no, clearly. And to this point, I'm so glad I put this line at the top of this slide of corporate VC approaching maturity, because Dominique made the same argument today. So there's a sort of, if you were watching his presentation earlier, he showed that. So I think that it's clear that we're getting more and more sophisticated practitioners within CVC who are now sharing their insights with others. And in our interviews, the level of sophistication of some corporate VCs, it's very clear they thought very deeply about these issues. Doug, I mean, your slide on PitchBook had the growing CVC activity in Europe.
Yeah.
Were you keen to comment on that?
Yeah, it's I think I commented earlier. It's basically doubled in the last 5 years, both in deal count and capital invested. So I think that we'll continue to see more of that.
I think time is up. Thanks to Toby and Doug. I would like to encourage every one of you to really support this kind of data collection that Toby and Doug are driving. Be excited about getting some insights out of these messages, and support the surveys. Right, this is how they get together and give us some valuable more information. Thank you very much.